everybody. Welcome back to the Financial Enthusiasts with Nate and Ashley. Today, we're going to be giving you an update on the gold and silver markets. They're up a little bit today, and I'm going to let Nate take it away. Go ahead, buddy.
Thank you. First of all, I want to start off with the picture of Mel Gibson from Braveheart. I've been, over the last couple of weeks, I've been trying to rally the troops, if you will. Some of the guys from Wall Street Silver, I wrote some things out for them. But I put together this stuff a couple of days ago before this big move up today, before the minutes yesterday, which led to the change. But I wanted to kind of walk through this. I did a solo thing yesterday, which I'm going to end up posting straight through. This one is going to have some dialogue between me and Ashley, so we can go back and forth a little bit to discuss it. If you just wanted the meat and the potatoes, I'm going to have a solo video that just runs through these slides. I know some of you just like the content, others like the dialogue. So we're going to go back and forth with some of these things. And I'm going to kind of start off at the beginning. Eventually, the concept here is a lot of the people that are Wall Street Silver that are kind of newer the last couple of months. They like silver, shiny, great. But what are the underlying macros? What are the technicals? What are some of the things going on here that you can kind of rally around right now? And so let me kind of start off with that. Basically, with my profession, I am an IT manager by trade. We're doing this over lunch breaks. So one of the things I did right out of college, I was a metrics manager for a company called Electronic Data Systems, and I worked at the Vanguard Group of Mutual Funds. And with that, you're trying to tell a story with charts and graphs, how good our services are. How did we do for trouble tickets the last month? So you do things with volume, quality control. And at the same time, I was going to Villanova University at the beginning of my MBA for something called decision sciences, which also dealt a lot with numbers and charts and graphs and stats and all that. So I have a pretty good background in a lot of this. And then about a year and a half ago, when I got into a lot of the gold and silver, is when I started actually seeing, technical charts for the first time. And my mind started getting blown away. I'm like, what? And as I mentioned to you in a previous video, a lot of these technicals might be somewhat outdated because some of the high frequency algorithms may have adapted to some of these things. So they may not be as effective as they once were, but I use them partially with price points to enter and exit now for shorter term trades, for long-term trades, that kind of thing. But the first thing I had looked at was something called the ascending triangle. And this chart formation, you can see the price goes up and it bounces around. And this top line here is a resistance line. The bottom line is a support line. It creates this beautiful ascending triangle, it's called. And then what happens eventually, it breaks out up. Now, with this type of triangle, the statistics on this is something like 70 or 80% of the time it breaks up, and 20 or 30% of the time it breaks down. Now, no one hold me to this exactly because you talk to different technical guys, they have different numbers on this. But the concept here, big picture, is look at this chart, okay? So from here, you also have something called a symmetrical triangle, and I'm going to go into both of these with gold and silver in the next couple slides, telling this whole story. So this is a little bit of background information. So with a symmetrical triangle, you see a price coming into and it's converging. What's happening is it starts to go up and hits a resistance line, then a support line. And this is the buyers and sellers kind of arm wrestling over what direction this is going to go long term. Eventually, one of them capitulates and then it breaks up or it breaks down. So here it shows it up, but symmetrical can break up or down. Likewise, how do you measure this? A lot of times you'll see like people will have lines drawn to a base or a long line, and then the external part of this coming out of this is how they can measure moves. You'll hear guys like David Hunter talk about price targets on this on this bust that's coming, so he's talking about price targets that we can get to, and I'm kind of superimposing some of my charts into what his targets are, and I'll get there in a second as well. But one thing to notice that I didn't know about back in the day was when things break out of these things, a lot of times they have what's called a back test. Yeah. So you can see here, I don't know, can you see my cursor?
Oh, yeah. Yeah.
Okay. So it breaks up out of the triangle. And then what happens is people start selling, taking some profits.
Right.
And then it comes down. And this first support line, this resistance line then becomes a support line for the next move up. Okay. So this is
Mhm.
kind of how you can see some of these things. Okay. Likewise, you can also see, and I'll show this also in a chart that I'm looking at, you can see like a sideways motion. You can see where it bounces back and forth between the resistance and support. And the longer this goes sideways, the more energy that can get built up. And
Mm.
eventually the buyers or the sellers will win out one way or the other. And then it's like a rapid move up or a rapid move down. So when I started this about a year and a half ago or so, some of what I was seeing was this is right after like the end of February, March. This is when I started to get into gold and silver, and the market just kind of dropped off a cliff.
Right.
Well, at the time, everything reflated over the course of the last year and a half. But at the time, we were trying to find the best companies to try to invest in, and I was not fully in gold and silver at the time. And my buddy, the former IRS agent, said, "Hey,
Uh,
I like this company called Mastech. This is a $70-$80 stock." And this was back in the day. This is a writing I did a long time ago, and this is a chart I'm looking at. I'm seeing a potential triangle forming.
mm,
So, okay, now this is back before I knew a lot about technical stuff, and I'm thinking,
right.
okay, this is going to break up. It's going to break up. And as you can see, this is kind of what an ascending triangle looks like. So
Okay.
this company, Mastech, around here, so I started buying some options. This is my first foray into options as well. So this is kind of what happened. This red circle here, I had bought options as this touched the bottom part of this ascending triangle. Now,
Mm.
they say it's kind of foolish to try and time bottoms and tops. You're an amateur if you do so. Well, I was an amateur. I still am an amateur, by the way. But what you're trying to do is you're trying to find price points to enter. And we talked about a lot of this in our options video we did a couple of
Yeah.
weeks ago.
Right.
So I bought here, and then it just kept breaking down and down. I was like, oh, geez, man, I'm getting crushed to this. But then I said, you know what? Let me dollar cost average. So I bought more down here. And then what happened was went back up, and I sold at this other line here. So where I initially bought, I pretty much doubled. And where I bought down here, I pretty much tripled. And for me, I was then hooked on options for short-term stuff. These were like $500, $600 trades. It wasn't anything. I wasn't dropping, 20 grand on these things or anything. But then what you could see is it broke up over the triangle, and then it came down to back test, right? But then what happened? Let's tell the story about what happened in Mastech over the next couple of months. So Mastech then decided to trade sideways. Okay. So here the time and price kind of went sideways. The RSI cooled off wherever it was. And John Howell talks about how John Howell's a technical guy on YouTube, by the way. I recommend anybody watching him to learn the basics. And I learned a ton from him. But from here, you see this sideways motion, and it builds energy. It builds energy. And this right now is what I'm seeing with SilJ, which I'll get to in a few minutes. That's the Silver Junior Miners ETF. But this is what was happening with Mastech. Now, what happened after this broke out? Look at that move. Okay. So if you look at this beforehand, it was a $60, $70 stock. And as you know, this reflation trade just went bananas. And this is what many of us are hoping for right now in gold and silver. We're waiting for this breakout. So with that, I showed the symmetric triangle retest and all that other fun stuff. Now let's look at silver right now. Now I went through some of this with the silver options video that we did about a month ago or so. Now with this, I noticed there was an ascending triangle. Now there was a line here that I created around 2775 or so as like this is a potential triangle because it's hitting this support, it's hitting this resistance, coming down support, resistance, support, resistance, support. But it also had touched $30 twice. Okay, so I didn't want to discount that as my ultimate goal here. But you also had guys like Michael Oliver and John Lee talking about, hey, the next time this thing goes over 2775 or 2750, this thing's going to blow a gasket. It's going to go crazy. At the same time, you're dealing with what's called the inverse head and shoulders. I'm not going to really get into that too much because it's not really formed right now. It's just a suspicion is there. And then Patrick Karim also did a video with Michael Oliver last week where they went over momentum structures and all that other fun stuff. Um, and I'm not gonna get into it too much here because as I mentioned, I might be having a chat with Patrick Karim tomorrow. I want to follow up more with him on some of these momentum charts that Michael Oliver introduced. But at the same time, we have an ascending triangle here with silver. We have this descending triangle with this momentum, and it looks like if you zoom in a little bit, there may be a breakout coming to the upside of momentum. So I want to ask Patrick if he thinks he might be able to back test some of these things to use technicals to see if there's anything to this. Now, I don't want to get into that too much, but let's look at what I was talking about earlier with this measured move. Now some people may just use the triangle itself. Other people would use the whole wedge here as the intro to where you're looking at the price point. But this move up here, you clone this and you add it to the top of your eventual support line. And if you look at it, you get something like 48, 44, something like that. Now you start to hear a lot of people right now talking about $45, $50 silver by the end of the year. This is where they may be getting some of this. Okay. If you can extrapolate this out and use this, if this is going to break out, which no one knows if it does break out and crosses over 30, it might get to 32, 34, and then back test 30. Now, this is the third time it could be going over 30. And usually you've seen it 3 or 4 times when it crosses over. Once that crosses over 3 or 4 times, that resistance then becomes support. This is how those technical rules are with this. So this is not hard science.
Can I ask you something?
Yeah, go ahead.
When you're doing like fundamentals and technical analysis, does it still count? How do I say this? Like gold and silver are probably one of the most heavily manipulated markets.
Oh, yep.
And with that manipulation, how are you able to follow fundamentals or these charts if like it's a manipulated ass? I mean, they all are at this point. I'm not trying to like pick on specifically gold and silver, but do you know what I'm trying to say?
Yeah, we'll look at 2 different kinds of manipulation here. Okay, the first one is the short-term price cliffs that we see. Okay, these are the things that you sign in at 8:30 and there's no news and you just see the cliff drop. Okay, so you can see a couple different things here. Like there was a cliff drop a couple days ago on like no news. Okay, none at all. Now, what I've noticed, I did some charts on this before. At the end of every month, between the 18th and 22nd of every single month, you start to see these drop-offs in the price of gold and silver. And what I did find out eventually, because I'm new to a lot of this stuff, people that have been doing this for 20 years are probably like, oh yeah, of course. But I had found out that a lot of those knockdowns have to do with banks knocking the price down so that they can collect the options premiums. We all saw this. Gold on Tuesday, gold closed at 25.99.80, which was what was it? Sorry, was it 17? Sorry, I was way off that. 17.99.
It's like I must have missed something.
17.99.80, 20 cents off of $18. So what you had seen beforehand was it knocked it down a lot beforehand into that, but the price action up here in this circle, when this all dropped off, this was the Fed then saying, well, we might raise interest rates sooner than expected, and then price action followed. So a lot of times what you'll see is maybe a stagnant price action or resistance at times where you're expecting the Fed minutes. Like here, people were expecting the Fed minutes today, and many were expecting it to be dovish as opposed to hawkish. So it hit this line and it didn't go anywhere because no one was selling off anymore. So they wanted to hold steady. Now, if that came out yesterday and said, hey, look, we're going to raise interest rates next month, we would have seen a drop off a cliff here. But meanwhile, what you're seeing is now another touch to a triangle. Okay. So that's kind of how price action can be correlated to what's going on verbally. Okay. So you can say the markets are also manipulated verbally by the Fed. So when they talk about, we might be thinking about something, and all of a sudden gold and silver drop off a cliff. That's manipulation. Okay. They call it jawboning, but what you're doing is you're trying to use words to move metals to affect a positive dollar in a sense without actually making any policy. So there are two different levels of
Wow.
manipulation that you can probably see these in charts closer to Fed, the times the Fed speaks and the Fed minutes, and you can see oscillations at 8:30 in the morning based off of jobs numbers. So these price things are not perfect, but this gives you a pretty good idea of what center field you're looking at. So when I'm looking at a price target here, if this price breaks above the ascending triangle, because there's no guarantee, but it's a 70 or 80% probability, because this is forming, it could squeeze up, but then you have no idea what could happen to break this down either. It could 20 or 30% possibility it breaks down. But if it does break up, history would say, here's a price target for you. But, if what you could have is your price target could be in that range, so it's not an exact science. And all these technical guys that want to give you, it's going to be $48.75 by end of January. That's not real because things move a lot. But it can give you at least an idea of the direction it's going if certain things happen. Okay. These technicals are based off of real world events. So you can see the action going up last year based off of certain events, but then too many people bought, right? Now I'll get into that in a few minutes. But moving on here a little bit, okay? So I also wrote a blog here. I want to talk about the definitive guide for investing in silver. And I did this to kind of help some of the Wall Street silver guys also kind of understand why we're doing all this stuff. I went into all of the different kind of fundamentals. I'm not going to go into this here, but these fundamentals support the technicals. They don't replace them, and the technicals don't replace the fundamentals. They kind of complement each other. Okay. So for instance, one of the things in here is supply and demand. Well, one of the things you learn about in economics, I don't have any charts up here. I should have put them up here, but one of the things you learn about in economics is government controls of price floors and price ceilings, how they fail. And you'll see things like a price ceiling or a price floor for milk might be $4. Well, if you have a price floor for something, you may run into problems with supply gluts. If you have price ceilings, you can't charge more than $25.90 for silver. You can't charge any more than that. Well, in a sense, when you have manipulation going on, that is a price ceiling. So when you have price ceilings, whether they're artificial or government sanctioned, if you have a price ceiling there, eventually price ceilings fail because you run out of supply because no one can afford to sell it at $25.90. So those ceilings and floors eventually will fail. And it's economics 101. I'm not talking about PhD level stuff here. So with the fundamentals here in silver, we talk about the supply and demand. And then one of the fundamentals is it takes 10 or 15 years to build the mine. And if you're suppressing the price right now and you're dealing with low float in the world at 1,000-ounce bars, it doesn't take a genius level guy to figure out the price is going to explode. And then you put that, you superimpose that into the charts and you say, well, if price does explode, this is why, this is when, this is where it's going to go. So with that, silver is essentially not allowed to move unless gold moves first. Okay. Well, you know what? I'll get into that next. But I also did this with the silver metrics. Okay. Remember I mentioned I was a metrics guy for EDS. So most people think of metrics as a percent of something, and that's great and all, but you can't necessarily. How far are we along in this silver squeeze? Right. Well, if you were to be a forensic scientist and try and put together a murder crime scene, and there's no body, you can kind of see where the blood spatter was. You can kind of see a murder weapon laying somewhere, and you can infer that the person was killed with a knife. Here's the blood splatter. Based off the time, you can figure out when it happened, and you can kind of recreate a lot of these things.
Very
Well,
good parallel.
the
I like it.
concept that I did with the metrics dashboard was I looked at certain things like the fundamentals. And right now you can see that we're at negative core interest real rates. Okay. The DXY, the dollar rate going down. I'll get into that in a little bit. Retail, how they were out of a lot of supply. ETFs, how they're gobbling up all these 1,000-ounce bars worldwide. And then you're looking at the industrial type of situation, and a lot of stuff right now where you're seeing with tin or chips, you're seeing supply chain issues. Well, that same type of situation may rear its ugly head with silver very soon as well. So, last but not least, I also talked about the short covering. I'm not going to go into this too much. I have a full blog if you guys want to look at this, talking about the metrics of the silver squeeze. So this goes on into all the different areas of it, of things that you might, if there was a squeeze ongoing, what would you look for? So this is what not a lot of people, I don't think there's anybody out there doing this. So this is kind of some, and if anybody wants to take what I'm doing and refine it, make it better, go ahead. The concept here is, if you're starting to see the DXY fall, that's good for them fundamentals, right? So, I'll get into the DXY in a little bit as well. But where I was getting at with that is also silver can't really move up unless gold opens the doors first. That's what a lot of people are saying. They say gold kicks in the door, but then silver clears the room. Okay. Silver goes bananas. It outperforms gold, but gold has to lead the move. So I looked at, remember that symmetric triangle, right? Well, we got one of those things going on in gold. Okay. Now with gold, remember in our options videos, I was looking at this. I was looking at, well, I want to sell when things are overpriced and I want to buy when things are underpriced. So I bought a whole bunch of stuff about right here on that triangle. Okay. When RSI was really low, I bought down here, and now gold seems to be moving up here. Now, one of the things that I didn't understand, I mean, I did, but I didn't, is when gold dropped like this, I bought all the miners. I was like, yeah, I'm in on GDX, I'm in on all these options, and then gold started recovering, but the miners tanked. I said, ah. So I've been getting crushed in my options.
Is there a reason for that, or is it?
Yeah. So
Oh, okay.
what they say is miners tend to lead the metals. So what this potentially was okay. There's a big drop in metals, and then maybe hedge funds, maybe the big institutional, they cut their losses and they get out, and that might also forecast lower metals to come. And there was a little bit more of a cliff drop after that, which you can see here. So anyway, I bought those options, and I'm about to get rewarded. I'm telling you, I think things are starting to turn around in a good direction for me. Today, lots of green stuff. I'm very happy about that. I'm actually, at the end of this, I want to bring up my options score sheet. Yeah, not that good, but it's better. So if gold then starts moving, silver will be right behind it. Okay. So with that, let's see, I talked about the mining stock options. Oh, what I had also done, I told you about, was I noticed that this RSI was really low, and I went back, and we talked about this in the options video, was when this RSI was really low, if you had bought here and sold here, well, look at that RSI. Well, you would have made out like a bandit. So I'm like, okay, well, maybe I should just back test this. So I went back the last 10 times that gold was this low with RSI, and then it went to that high with the RSI. And I went through that whole thing, and I came up with the fact that it looks like an average. The last 10 times it moved from that low of an RSI to over 70 of an RSI, it looked like it was an average of about $206 move over 58 trading days of about a 15.5% move, 1555, whatever it is. Usually miners move about 3 times, big miners move about 3 times the rate of the metals, and then options move a lot further than that. So if I get a 15% move in gold, I'll have a 45% move in GDX, but those options may be like 200, 300%. So that's where I was going with all of that stuff. But Likewise, I also did something. I started this at the end of June, early July. I put together something called a gold sentiment index because last year, you remember, well, I'm not sure you were following it then too much, but gold went way up over 2075.
Oh, I
And
remember.
and man, that RSI, look how high that was. But at the same time, all these talking heads were like, guys, you gotta take profits. Guys, you gotta sell. Guys, you gotta get out. And people like me were like, buy, buy, buy. Now I was luckily out of a lot of stuff for another reason, and I had a lot of cash. But a lot of people were coming in then and bought at the top. Okay. And what they saw was like 10 months of pain. Okay. I was buying on some of these dips, so I didn't do so bad over last year. It's not been great, but um, the same talking heads that were warning me to get out then, what were they saying down here? So that's what I
What
did.
were they saying?
I went and I looked them all. I
Of
looked
course
them
you did.
all of them up.
Not
Okay.
surprised.
Yeah, yeah. So I got 28 videos I'd seen of different people. And what I did was I found out not necessarily long term, because everyone's long term bullish gold, everyone sees the long term trend, but what were they thinking for the next month or two? Because that's what my options were. I cared what the hell was going to happen to my GDX options by September 7th. So I don't think it's going to be great by September 7th, but it definitely, the sentiment here was very bullish. There was a couple people that were bearish, but some of them were basically saying, well, I don't necessarily like July, but it's going to pick up in August and September. So even the people that were bearish were all kind of admitting, in a sense, that things are going to look pretty good towards the second half of the year. One guy, I'm not going to get into it too much, but one guy was kind of like, yeah, we're not going to have a breakout at all the second half. Out of 28 people, and he might be right, I don't know. But the same people that were telling us last summer to get out, 61% of them are saying, hey, you should probably go in, and 18% were neutral. So for me, it only looked like 21% of the people were saying, yeah, you probably shouldn't be in right now. So I said, you know what, that's pretty good. So the same technical charts that I was doing before, how are these going to work out for like the GDX? Now, um, GDX 36, 38, 39 options for September 17th are what I got. So this is a channel that was trading it. Kind of a similar, kind of like how the rules of the triangle went. You could see a channel forming where you have, it's a downtrend, but it's like it's called a bull flag. So ultimately, this is a continuation pattern. So you'll see something coming up. It went way too far overstretched, and it's consolidating a little bit. And then when it's done digesting everything, it's a good base for the next move up. So this is kind of where did I buy stuff? I bought stuff about right here. Okay. So it was down here, but if you look at these measured moves, this potentially has the GDX at 64. What is that? Yeah, that's not going to be that's not going to be by September 2021, but it potentially shows a strong move up. Now you can move this down here maybe, and maybe that has September, that might have it at 45. It's showing a potential strong move up whenever it digests whatever it was doing. Okay, so that's how I was playing this channel play. Okay, likewise, still J. Remember that channel move sideways we were talking about before, and then that massive move up with Mastec. Well, if you do that here, that same concept here, you're looking at a target that David Hunter was talking about, $32 to $35. Where does he just pick that out of thin air? Or were there potentially technicals that kind of led him to some of those numbers? So if you use this concept where it goes forward, it retraces a bit, and then goes on with a continuation pattern, that's where you can see potentially $30, $32 SILJ. And the timing for this is April or so, but my options expire in January at like $23, $24, something like that. This could be a violent move up though. And I'm going to get to why this can be something like, I mean, I know I have the measured move there, but it could be like this. That would be beneficial for my options. And I'll explain why right now. So if you're looking at the dollar, okay, one of the big contributors to the metals prices is not only the real rates, but the dollar can tend to have the short term tailwind or headwinds. But the biggest correlation has to do with the real rates. Okay, I'll get into a chart I saw on that a little bit later. But um, what you're looking at with the dollar is, I thought I potentially seen a technical formation as a double top. Now, this may not be exactly how a double top is formed or it looks, but the same concept is true. It tried to run up, it failed. It failed once, it failed twice, and now it's breaking down to where it came from. And where did it come from? Down around 80. Okay, so the concept here was in the next year or two or 6 months, you could see potentially the dollar breaking down further. And what we just saw yesterday from the Fed speech was, okay, I'm going to be very dovish, and next thing you know, the dollar starts tanking downward. Now, I called this the Maginot line. I don't know if I made that up or if somebody else. I've been calling it for such a long time, but if it breaks down below 89.5, remember when I was talking about support and resistance lines? Well, the next real support line you get is down here. I did think I saw somewhere around 84, 85. Here's a line that you can draw, but it may go right through that down to a stronger resistance around 79, 80. And so that's the formation I drew. Now, there's a lot of big macros going on right now that suggest that there's money printing out the wazoo, right? $3 trillion infrastructure bill. There's all kinds of things going on where there's just money coming and coming.
Can I say something?
Yeah.
Just to interrupt very quickly, there's an amazing article on Market Watch right now that is really giving you sort of it's written by Neil Howe, and he like predicted this huge unrest that's going on right now, sort of the fourth turning situation, and how all of this ties in together. And MMT, right? Like, how come there's no there it right now? Yeah, okay, inflation is higher than expected, but it doesn't seem like there's a ton of consequences to MMT, which is kind of crazy.
I'm getting there. I'm getting
Okay.
there. Oh yeah, of course I am.
I trust in you. Okay, go ahead.
So right now, this dollar breakdown is because of all this money printing. And the big thing most people are afraid of with that is a March 2020 event where the cliff dive happens again. But back then, they didn't have all these QE instruments they could just, spin up immediately. And what I would suggest here is that they would print the money into oblivion in order to save the stock market, in order to save Apple, in order to save Tesla. And with that, I would suspect that there is going to be a hard down. And most people have talked about this 89.5 or 89.4 line. So this isn't my original work here. But once it crosses through there, you can see why it may fall to 85 or 80, as David Hunter suggests as well, with what he's talking about next is 85 or $80. And this kind of pretty much goes in line with that. And if you step out and look at the dollar from a larger perspective, let's go back a good, 40 years. Remember what I was talking about, a symmetric triangle? I'm not seeing anybody talking about this right now. And I'm seeing a symmetric triangle that's forming. And with this symmetric triangle, remember we talked about breakouts? Well, we're right now pretty much at this resistance line, which just so happens to be around that Maginot line I was talking about. So this could then have a hard breakout down out of that symmetric triangle. Here's where you can get your 80 or 85 or 80 drop. And then basically, I'll get into it further, how the DXY can go up from here as maybe like a false breakout down. But for now, this is how I can see, look at this line of support, that once this is broken, I could see capitulation and a sell-off down to 85 or 80 very easily. And I can see where David Hunter gets it. But I'm not seeing anybody talk about this triangle. So one of the things that was very interesting is this big move up from 79 to 100. I want to know what macro events took place over 6 months to move the dollar up that high. I don't know. And it was possible it was because we were getting rid of all of QE. We were done QE and the dollar gets stronger. Well, that's about to get stood on its head, which could also go with the narrative that it goes back down to 79 or 80. So that's, and if you're removing, if you're taking the dollar bill, the dollar down to 70, down to 85 or 80, that also leads the way for then gold to go back up to perhaps that, perhaps maybe a $2,500 move. Now, remember, I was talking about, did I have it on this chart or not? Oh, here it is. So I drew a line, this green line here, and suggesting that if the dollar is about to falter, this is how all these guys are all of a sudden coming up with $2,500 gold. They didn't just draw it out of a hat. When I drew this line, it comes up to 2503. And I'm like, okay, I can see that. Now, how does it get there? A dollar drop. Okay, so let's see. Let's move forward. Okay, remember I also said real rates are kind of an impediment for gold moving up. If real rates are not negative, that will stop gold moving up. But right now, we keep seeing rates fall while inflation goes up. That makes a higher negative number. Okay, but if you look back at 40 years of our 10-year treasury, it almost looks like a computer drew this. Look at the support and resistance lines. And this big black line here is 0%. So I asked the question, what happens when inflation is deemed not to be transitory and everyone holding debt at 1.2% realizes they're in an 8% inflation world? Sell-off, government buyer of last resort, and yield curve control is the only thing slowing the rise of rates. Debt bomb. Real rates continue to dive deeper into negative territory because what I'm suggesting here is you see this whole, you see this move here. This down move here could be interest rates starting to move up when people sell off. And how does it then reverse? Well, we can't really stomach higher interest rates because we have $30 trillion in debt. So you can't rise the rates over such a number because if you do, we default on our debt. Okay. So here's where you get into that whole MMT thing, because when inflation starts running higher and higher and higher due to more money in the environment. Now, advocates of MMT would say, oh, there's no inflation, but by definition, you're increasing the monetary supply and you have a fixed number of goods. Just do the simple math. If you have $100 for 100 widgets, that's $1 per widget. Then if you have $200 for 100 widgets, that's $2 per widget. That's an inflation. That's inflation.
Love that parallel, by the way. Very visual.
So what happens is if you own debt, I'm going to get into this one here. This is real fun. So those numbers I now have on TradingView only go back to 1980 for some reason, 81. I did go back earlier before and I did this chart up, and you can actually see the 10-year, what happened all through the inflation in the 1970s. Look at how the rates went up, okay? Because inflation was high, okay? Do I have the inflation up here? I think, oh, yeah, here are the inflation rates in the 1970s. Month by month, year by year, look at these inflation rates. Just now we got over 5.4% and people are panicking. Well, CPI has been adjusted down multiple times over many years. And the suggestion is that a 5.4 right now might be an 8% print on here or 10% print on here. So I went back and I looked at this 10-year and it looks a lot like this, the market psychology. Have you seen this chart yet, the market psychology? Yeah. So basically what I'm looking at is, let's just say for argument's sake, this 10-year rate has been artificially juked downward by false reporting of low inflation. Okay. Let's just say the government is saying it's 2% inflation every single month. So if inflation, if the 10-year is a trailing indicator, it's basically saying there's less risk of government defaulting. So I'm going to lower the rates. And that's what this is saying. But what this is also saying is that the party could potentially be over. And what's going to happen when real rates, real inflation is seen? What the suggestion is a repeat of the 1970s, where the rates are going to start to go up, just like it did in the 1970s, because it trails inflation. Okay. So what's very interesting here, a lot of people don't know this, I only knew about this about 5-6 months ago, is that when these rates go up, the value of the treasury or the bond go down. It's an inverse correlation here. So when you start to see these rates go down, watch on the chart here, you start to see these rates go down, the value of that treasury goes up. So if you bought treasuries for $100 here,
Yes, and
the
price
treasury,
and yield of the bond is a difference. Okay,
yeah.
this is coming full
So
circle for me. Got it.
if you bought treasuries for $100 here, maybe down here they're worth $200. Okay, so the value of them went up, their yield went down, but the value of them went up. So what I'm suggesting is that 100 was artificially inflated to 200. And when that happens and these rates start to go up, what then happens is everyone that had it for 200 is going to start selling it off, and the debt bubble is going to go boom. Okay, so I wrote about this, of course, and I call this transitory deflation, where David Hunter talks about this whole deflationary cycle happening over the course of a year. Most people aren't considering the fact that there was actually inflation for 40 years leading into this, because the government kept saying it's 2%. But if you look at shadow stats, you can consistently see it's been 5%, 5, 8, 10% for many years. So the concept here I'm saying is that this boom, this move down in the stock market that is coming is going to be because of something I call transitory deflation. It's the fact that there's inflation, then there's a transitory deflation, and then inflation will resume with potentially hyperinflation because the MMT money supply.
That's even what Mike Maloney says. Yeah.
Yes, and instead of $200 for 100 widgets, it's going to be $1,000 for 100 widgets. Because to get out of this deflationary system, the deflationary impulses, which is like the 1930s Great Depression, the way to get out of that, print more money. And then that's where Mike Maloney is talking about the money bombers. But no one is talking about the concept of transitory deflation. And I go into it further, of course, into a blog that I said the pin that pops the everything bubble, the takedown incoming. And of interest here is that when you're looking at this gold move here, the thought was this move down here could be potentially when interest rates start to move up. Okay, so gold reacts negatively. And people say, oh my God, the gold move is over, it's all done. But as interest rates go up, what you cannot have happen, you cannot have this high interest rate. So then what will happen is people are starting to sell off their bonds and their treasuries, and institutions are selling off their bonds and treasuries to get what they can for it. The government is buying it hand over fist over hand over fist over hand over fist, and that is essentially your yield curve control. It prevents the rates from going sky high, and it prevents the boom of the market drop. And this, I believe, is where you get that next move up for gold. Whether, and I have this to January 3rd of 2022, whatever it is, at some point in time, that yield curve control may get overrun because inflation could be 12%. And it's at that point in time where the Fed can't talk it down anymore. They now have to admit yield curve control is in play. But if the government is the buyers of only resort, now you have countries, sovereign countries like China that had 3 trillion, last I heard, 3 trillion or so in debt that they hold. What happens when they start selling it off? It's quite possible that it overruns yield curve control to an extent because the Fed balance sheet will get blown out. And this is also what David Hunter was talking about. The Fed balance sheet could blow up to 20 trillion. How? If they're the
Whenever
only
I hear you
ones.
talk about this stuff, I'm reminded at just how complex of a beast this
Yeah,
really is. Like it's
yeah,
really, um,
yeah.
uh,
You
uh,
ever? I've
yeah, it
never
just sort
flown a
of leaves you
plane.
speechless, you know? Oh my
I've never
God.
flown a plane, but this is what I imagine it's like. See these bells and whistles, okay?
Good Lord.
So, so the concept here is if this is now deemed an inflation play, okay? Now, what a lot of people don't understand is that the last time we faced inflation like this potentially was 1971. Now that moved for a decade, and the concept is that I don't think we could stomach inflation for a decade because we would default on our debt. So they have to hyperinflate us kind of essentially out of our debt. But there were no money managers essentially today that existed then. So you're dealing with a bunch of 20, 28-year-old, 34-year-old Wharton degree guys that are Keynesians that deal with MMT that they actually don't know how to react to investing in inflation. And I can tell you, I think people that are in on the gold scenario, people that are in on gold or understand what's going to happen when you sell stocks. They call it risk on, risk off. I'm getting out of stocks. This is crazy. All this is going to go kablooey. It's now a fear trade where you go risk off. Okay. Well, what is risk off? Where do you go to? The first thing you do is you liquidate and you go to cash. Okay. This is what makes the DXY start to go up. Okay. So you have stock market selling, stock market selling. You get your either cliff dive or that arm wrestling match for 3 or 6 months where people are getting into cash. Okay. But the other thing that people go to the safety trade are the treasuries. That's the very thing that's causing the problem. Who the hell's buying treasuries if it's catching a knife and it's going down? The third fear trade here I'm looking at is gold, because gold will at least help you maintain your wealth. So if you're not supposed to get rich off of it, you're supposed to maintain your wealth. And we saw, can you guess? I may have told you before, in the 1970s, if you had bought gold in 1971 and sold it in 1980, do you know what kind of move gold had? It went up 24 times. Not 24%, 24 times. Silver went up 29 times. So the concept here is that there's about to be a massive commodities boom. Now, I don't know when it's going to be. I don't know if it's going to be, um, you know, after we hit, 2,500 gold or whatever it is, after we hit that, as Hunter suggests, everything can drop down to 1,600 gold, 1,700 gold, 1,800 gold. There could be a strong correction in gold when everyone's selling off everything, and then the DXY is going way high. Okay, but I need to ask you a question: if if the debt bomb is blowing up, and you're not putting money in, you're not putting that cash into treasuries, and simultaneously you're looking at 10 or 12% inflation, why would you want to be in cash? So now you got to take your cash and you got to put it potentially into gold, commodities, blue chip stocks. And this is why I wouldn't short the market either, because there's that possibility of what David Hunter says is a 65 to 80% market correction. That's possible. It's probably likely. But what happens if people are selling off a lot of these stocks? Potentially a lot of these zombie companies, the 38% of the S&P or something like that are zombie companies that they can't maintain their own debt without defaulting. So if I'm a money manager and I'm 6 months now down the road, I'm 12 months down the road, and I now am looking back on history. How did they invest? Who were the big money makers in the 1970s? Oil, gold, silver. Okay. To an extent, copper is going to be huge. Battery metals are going to be huge because you know what? This infrastructure thing of 3 trillion is going to be nothing compared to the 10 trillion one they pass. And this is going to have them, because oil is going to be $150 a barrel, gas prices are going to be crazy. They're going to say, now we need to go green. So they're going to want battery metals, they're going to want silver, they're going to want copper, because they got to get away from oil, right? And this is going to drive gold and copper through the roof. So the concept here is, if I'm a money manager, where am I putting my money? Now, Tavi Costa put this out a couple of days ago, maybe a week or so ago. And right now, I'm looking at it, you can see all the major gold miners are just making money hand over fist. Free cash flow is just crazy. Now, this is inflation adjusted, it looks like. Aggregate free cash flow yield net of consumer price index year-over-year change, real cash flow yield by sector. So the concept here is, if there's an inflation play, where are you actually getting money in your stocks? Okay, because let's just say your Apple stock goes up 10%, but inflation is 12%. Nominally your stock went up, but your purchasing power didn't increase. So you're now trying to find those green areas where your free cash flow, your 15% Barrick is more than the 12% of inflation. He also put out this other one. Where is this at? Okay. So if you look at the tips, now I don't know much about the tips. I brought it up here. Treasury inflation protected securities. So the concept here is, this kind of measures, you can see how there are treasury inflation protected securities, or type of treasury security issued by the US government. Tips are indexed to inflation in order to protect investors from a decline in purchasing power of their money. So essentially, this is supposed to move up with inflation, okay? And they inverted this to measure this against gold.
Can I ask a question? Is
Yeah.
tips different than a treasury? Are
To the
these
best of
two
my understanding,
different
yes.
instruments?
To the
Oh,
best of my I don't know much about it.
oh,
I
okay.
can't tell you much about it.
Yeah,
I'm
cool.
not. These are the types of questions we ask the pros, not amateur. Okay. So what I can tell you is, you can look at this correlation, and at the sniff test, you can see the measure of inflation going up with blue, and you can see how gold has lagged recently. So one of two things are going to happen. Inflation is going to come way back down to gold, or gold is going to go way back up to inflation. So my money is that inflation is here to stay now, because, again, now the Fed, was it 3 or 4 months ago, the Fed came out and they said, this inflation is going to be transitory. Okay. Now this has been beaten to death, but originally they had said transitory was a couple months. It should subside. It's year-over-year base effects, because it was such a dive in the economy last year. Now, if you're measuring it year-over-year, those things are just they're gonna disappear. However, those base effects have been disappearing, and we're still seeing the 5% inflation. Now, they want to attribute a lot of this right now to supply chain. Now, it's quite possible for certain things like lumber, they're correct. Okay. Now, Michael Oliver had this great thing he talked about lumber. He said it was a one-off, because he said there was a situation where there was a lot of people, a lot of affluent people in cities that were getting the hell out of cities, and they were building houses in the suburbs. And this is what was a spike for lumber. Okay. This is what created the lumber to go absolutely bananas. Well, when all the people that moved out of the city moved out, those lumber prices have now collapsed back down. So Powell is now pointing to that, saying, see, this is kind of transitory, but you're starting to see everything else continuing.
Using the one example he has.
Yeah. Yeah. Now you can see it in certain things. I think corn, soybean, there's certain things that you can start to see it recede. But the concept now was, well, this transitory, it could be persistent. Then they used the word temporary. And then I saw one of the governors say, well, this could persist now for 6 to 9 months. Another one said 9 to 12 months. So now, yesterday, they were changing the definition of transitory on the fly. Now get this. You saw lumber go from 700 to 1500 back down to 700. Okay. That's what me and you think of as transitory. Price revolved back to where it was. However, he just mentioned yesterday, well, the price gains that went up, they may not come down at all, but we're just slowing the rate of change of inflation going higher. So those rates of changes that just happened are going to stick, but we're going to decelerate the rate of inflation in the future. So if inflation comes down to 3% or 2%, they're not reversing those price changes that happened over the last 3 or 4 months. So you saw that shrinkflation with cereal boxes. That's not going away. They're not suddenly going to give you 2 ounces more Cheerios in the box. Okay. So that's kind of where we're going right now. I wanted to kind of go over the big macro sense to kind of get some people wanting to run through walls right now. And right now, it was great timing for this because I told you earlier in the week I wanted to have a discussion on this. But just today is when we had this gold breakout. Well, it was kind of late yesterday, and now today it's green. And my hope is, I'm going to zoom in here on this a little bit. And so this is the gold. What I'm hoping for now with my options play, remember, I bought down here. I bought all this stuff down here. My hope is gold continues up in this path, breaks out over this, and I'm probably going to sell when it breaks out over this triangle. Now, it may go up, and then when it comes back down, back test this, I'll probably buy more options for the next move up. So that's, I'm looking to sell, and you know what? As luck would have it, I got the RSIs here. Look at the RSI. Now, it may go, it's running real hot with a green candle today. But if this runs up over this triangle, you can bet your RSI is going to be up over here. That's when I'm selling my options. So again, but this is what people can expect if this pattern, let's just say gold doesn't go in the tank tomorrow. If this pattern does continue, you'll look for gold to go over this triangle. You'll look for the back test. And then that's when once this comes back up off of this back test, that's when I'm going to be gambling with a little bit more options. Now, I'm not going to gamble my kids' college fund. What I'm going to do is take profits from this options run. I'm going to take those profits and then use a lot of those profits to then get some more profits. So I'm not really going.
So sensible.
I'm not using my base money, so to speak. And then last but not least, I wanted to share out. Oh, let me just drag this over. Where is it at? I did have it up. Here we go. I'm going to bring this over. My options. Okay. Now this was all deep red the other day. So I have right now 37 or so into my options, as you can see on here. Okay. I'm down 19. This is a scary, scary number. But if you look at the SILJ ones I bought most of these in February and May and June before that big crash that just happened. Okay. So, and all of these expire January of 2021. Remember when I was saying basically SILJ could be $24, $28 then.
You mean January 2022?
Yeah, 2022.
Okay.
You're right.
Sorry, just had to make sure.
No, it's January 21st, 2022. Okay. So right now, I also, the last couple of days, as you can see up here, I saw, man, this is a great time to buy some more stuff. So I took some profits that I had off of some junior miners or whatever, and I took them off the table and I bought, and I'm already double on something I bought a couple of days ago. It's not a lot of money, but as the price rises, I can then start selling into some of the price rise. So no one's going to be able to call the top here on this, but if I get a triple on some of this, take the 3-bagger, it's $500. Okay, take the 1,500 off, because some of these, it may not reach back to where I'm expecting. I may take a loss in some of these. So I may end up this play putting in 36. I may get 54 out of it, and I may bank 50% profit on this entire options thing. So who knows? I don't know where this is going to go.
Nothing wrong with that return.
No, not in a 2-month thing. And you know what? That helps pay down debt, and it helps invest in the next run of options. So if I lose out on my next options, I'm not taking away from my pile of base money. Okay. So this one here, I went irresponsible. I went way deep on these. And I did that because of that whole RSI thing. And one of the things I want to talk about with Patrick tomorrow, if we get into this, is I want to ask him about back testing low RSIs, because I saw some comment on somewhere where RSI shouldn't be used as an indicator to do as buying. It's a lag indicator, but I did a back test on that of 10, 15 sessions, and it looked like when it's that low.
But didn't you do the RSI with the MACD as well? Like one of them might be a lagging, but then that MACD one.
the
Let's,
MACD was the lagging one. So if I was an investment
oh,
professional,
all
I would
right.
look at the RSI and then I would watch the MACD, and then I would then at that point when it's further de-risked, I would buy in after the MACD crosses. So I don't run a fund. You know, I got the fund of mate. So if I screw up, I screw up. But I don't have other people's money that I'm managing. So I don't have those risk rules that they have. And you know, I'm 45. I'm not, you know, I've been blessed with these types of interactions with people from Twitter and stuff. I was writing back and forth with this guy, Jim, that he's like, but I'm 75. What do I do with the money? And I'm like, that's a completely different scenario. I'm sitting here playing with some options because if all of these go to zero, I still have 20 years of earning that I can make that up. So I know we put our disclaimers in these videos, but everyone listening to this need to speak to their own financial investors. Don't listen to me. Don't listen to Ashley, but see where I'm thinking. See how I can
Definitely
make some
don't
money on
listen
this.
to
Because
me.
so at the end of this, let's just say I come up with a 50% gain in this. Okay. Then we can learn from that. What did I sell too late? Did I hold on too long? We can dissect this move. So the idea from this was I wanted to kind of teach people about options. I wanted to show them how they can track them because, you know, when I bought them in the options video, I said, hey, there could be some downside risk here yet, you know, so don't do what I'm doing. I tried to time the bottom. I did get the bottom of gold, but I didn't get the bottom of gold miners. That just fell that that bottom fell out of that one. So for everyone watching, gold and gold miners are not 100% correlated because you would see things like last summer, gold was going up, silver was going up, and I was seeing my miners actually going in the red, and I was losing my mind. Like, what's going on? All those fund managers realized that gold and silver were so far overstretched, they were selling profits when I'm just watching gold and silver go up. So it's very, if you're starting to see miners lead, I'm starting to now think, okay, well, if the RSI starts hitting around 70, I'm going to start seeing gold and silver miners start to sell off. That's when I'm getting the hell out. Gold and silver may run up another 5 or 10%, but so what? The miners aren't, and I'm invested in the miners. So with that, do you have any questions to lead out of here? I know I kind of went really long with this, but did I bake your noodle on any of this? Did I kind of?
Oh yeah, I'm cooking over here. No, it was really, as always, Nate, you're so, you're not a glamorizer, which I really appreciate about your approach to things. And,
Oh, I could lose my ass in this, you know.
oh yeah. And I mean, yeah, but I mean, again, you still have your risk controls in place.
Well,
And,
I did kind of also bypass them a little bit on this one. Like I'm not going to go into it too much here, but I made mention that typically when I have these risk rules, I'll have a stop loss where I cut out at 50, but I had 6 months left in these SILJs, and I knew there was going to be volatility ahead, so I kind of turned off my risk governor here. But you know, one of the things, oh, just to make mention of that mass tech thing and other stuff, like what I used to run into some issues when I first started doing options was I used to have my stop losses real tight. And you know those 830 smashes that happen? So what would happen was market would open up, I would get stopped out, and then I didn't have the capital to buy back in on a recovery. So I would get stopped out all the time on these things
okay.
because I had
So
really tight stop losses.
that's the
So
danger of the stop loss. Gotcha.
yeah. So
Kind of a catch 22.
yeah, so I knew when I at this buying place where I bought, I knew it was highly risky, and I knew this was going to have some downside risk. So yeah, you just mentioned um, rules of risk. Uh, People that do this for a living probably have many more trades than I do, and then they have those tighter rules, and they're out at a 10% loss or they're out at a 5% loss, but they may do 100 trades a day, and they win 60 and they lose 40. So I don't have that kind of time. Me and you, we do part-time trading, part-time stuff. So
I mean, you're a family man and you've got, a career and stuff. So,
yeah,
that's what I mean when I say, you're not, even though yes, you're taking some risk, but you're not gambling your entire portfolio or your kid, your son's college
right,
fund.
right.
you know, and that's where I think people can learn from you, in the sense of, you know, taking the time to look at, you know, some technicals, some fundamentals, and then, you know, taking that, what they're learning from you, and then assessing their own risk tolerance, where they are
Yeah.
in their cycle, right? Like you're, you know, the gentleman you were chatting with who's 75,
Yeah.
it's a
So
different situation for him.
yeah, when you're dealing with options and risk situations, you might look at 5% of your portfolio or 10% or something, just as a general rule of what to gamble. I kind of went higher, and then I got smacked with an oar, with the miners dropping off the face of the earth. So you're right. You have somebody like the Jim I was talking to who's 75. He was a former accountant and stuff. He's like, well, what do I do with my money?
Right.
And really, that's the big question today. And really, it's like I put out another one, early this morning. I think it was this one where, I talked about different ways of dealing with it. Now, me and you have talked about before, well, what's going to happen if the market crashes tomorrow?
Right.
Well, what happens if it crashes over 8 months and not tomorrow? If
Right.
it crashes tomorrow, gold and silver can get taken down with it. But if it crashes over 8 months, it's quite possible you see rotation out of tech
Right.
stocks into gold and silver, and they never
Right.
crash. So there's all kinds.
Interesting.
There's downside risks, upside risks, and
Holy.
no one is right. No, don't listen to me. Don't listen to any of these guys. But if you listen to enough of them, you can kind of form your own strategy, talk to your own financial
Exactly.
advisors, and figure out your level of risk. So with that, you have any other parting words here?
Um, I mean, I think it would be interesting to maybe post that Market Watch article by Neil Howe in the video description,
Yeah.
because I think it really goes into some important macro indicators that are, you know, beyond the markets, so to speak. They include, you know, social and political outcomes that really do affect, you know, all of that stuff is so connected now. So, I mean, you know, you really can't separate them anymore. Not in the upheaval that we're in and is going to come in the next decade. So, having said that, you know, good luck tomorrow on Patrick's, you know, on
Well, like I
Patrick's
said,
chat.
I don't know if we'll get one chart in or if we go through all this, but I wanted to actually kind of lay this
Yeah,
whole thing out as a background.
no, it's
Yeah.
fantastic. I mean, this would probably be a good place for viewers to start, and then go and, you know, check out your chat with Patrick, where maybe they can get, you know, sort of the Coles notes of the situation. But as always, Nate, you know, thank you so much for, you know, the time, the detail, the thought that you really put into everything.
This is
I know
fun.
I know, and that's what makes you amazing, is that you actually think this is like the funnest stuff. And then I'm so lucky that I get to like share in this knowledge and learn from you. So thank you to
One,
our
one,
viewers. You
one,
know, oh, sorry.
one last thing, and I'll lead it out, but
Yeah,
maybe we can have a follow up with this in 2 or 3 weeks to see where we're at. For all I know, this
why
thing can
not?
drop off a cliff,
Why
but
not?
we can catch up with some of this and see where we're at. Everyone, I'll add the links to my blog posts that are much longer than this into the description, and be sure to check out Ashley's new webpage.
Oh,
I'll
thank
also
you.
put the link on that.
Thank you.
With that, everyone, we'll catch up with you hopefully next week or the week after.
Yes,
Thank
thank you
you.
so much, everybody. Remember, like, comment, subscribe. We love to hear from you, and it really helps us with the YouTube algorithm. All right, everyone, take care.